Hello, everybody, and welcome to our webinar today. I'm really glad everybody could join us. So today we're going to be diving in. We're going to be talking about the third and final type of financing that a borrower can obtain, known as collateral or asset-based financing. So in the last two trainings, we've talked about the 3C's formula of lending, how somebody can actually get financing for their business based on either cash flow, credit, or collateral. So today we dive into the third C, the collateral-based financing. When we talk about financing, it's also called asset-based financing, which is where somebody can get money using an asset that they have as collateral to be able to obtain that loan or credit line. Now, what we're going to dive into today is the lowest price, the most affordable type of financing that exists out there today, cheaper than cash flow financing, cheaper than credit-based financing in a lot of cases, and even cheaper than SBA type financing, which, by the way, we'll be talking about SBA financing as well. So when we talk about collateral-based financing, there's really a couple different types of collateral that may work. Almost any kind of business collateral can work for financing, and some types of personal collateral can work as financing as well. So a lot of business assets can serve as collateral, very few personal assets can serve as collateral. So when we talk about business assets serving as collateral, some of the many that we will cover today, we're looking at any kind of asset the business has: account receivables, purchase orders, a book of business. If they're an insurance agent, maybe they own equipment or inventory, or they have commercial real estate or commercial vehicles. These are some of the most common types of collateral that are out there that is business collateral. And on personal collateral, we're usually looking at stocks, bonds, IRAs, 401ks, or we're also looking at residential real estate. For example, if somebody's flipping a home, where we could use even their own personal home as collateral for SBA loans. Most other financing won't use that type of collateral, but for SBA loans, that is something that can also work. So we're going to dive into each of these, and we may talk about some other forms of collateral that are not on this list as well. So let's start with house flipper financing. So this is a type of financing that's specifically designed for house flippers, people that are actually flipping homes. And this is the kind of financing where somebody can get 100% all the money they need to both purchase the property to flip and then even rehab it, fix it up so it can be flipped. Now, lenders are going to want to loan up to 65% of after repair value. Those two can look like they contradict each other. So let me explain that. If somebody buys the property really right, then they can buy the property, fix the property, and still do it under a 65% value of what it's worth after it's fixed. So that's what the lender will go up to. The lender will look at the after repair value and will loan up to 65% of what the house is going to be like once it's rehabbed, once it's completely fixed up. Now, typically the borrower is going to give a 6-month financing because, again, this is a fix and flip type of loan. We're expecting the borrower to be able to fix and flip that home within 6 months. 6 months, if they can't do so and they get near the end, well, then the lenders will give them an extension. Of course, they'll charge more interest, but they will give them an extension on that 6-month term. Now, rates for this kind of financing are 8% or higher. This is oftentimes referred to as hard money, which I think is interesting because in business financing, we deal with rates of sometimes 35 to 65%. So to me, 8 to 15, 12% is not hard money. But again, in the house flipper financing world, this is considered to be kind of a hard money type of financing. So a borrower is going to need average credit, about a 650, 660 FICO score or higher. Obviously, if they have a bunch of recent payments that are late on their credit report, that could be an issue. Because remember, in any kind of financing, all the lender really cares about is the borrower's ability to repay that debt. So again, credit reflecting they're having a bunch of current credit or current issues or current difficulties in paying their bills probably is not the most welcome. That's not what we want to see. Okay, the second is lenders will want to have flipping experience. Look, everybody wants to flip homes. Everybody does. But the reality is that lenders only want to lend to people that actually know what they're doing. So you're talking about somebody that has some kind of recent experience. Now, the lenders don't typically map out exactly what that defines, but we find that a lot of them like to see 2 or 3 recent flips over the last 1 to 2 years. But again, that's not a steadfast rule. It varies based on lenders. What we're looking for is somebody that's already done flips before, and somebody needs to have cash on hand to put into an actual escrow account. So the lender's going to want the person to have skin in the game. They're going to make them put that money into an escrow account. It doesn't have to be equivalent to the amount of money they're borrowing. It just needs to be a pretty good sum of money. So we've had clients before need to put 30 or 35,000 in that escrow account. So what the lender's looking for is credit that reflects that the person pays their bills, some experience in flipping homes, and again, enough cash in reserves that they can put into an escrow account to offset the lender's risk. Now, the nice thing about this kind of financing is that you could typically get multiple loans ongoing at the same time. So lenders will lend multiple loans to the same borrower if the borrower meets this criteria. But again, if you're dealing with offering these kind of loans to borrowers, very rarely will you see that people meet this criteria. 9.9 out of 10 people you talk to are dreamers in this space. They want to get into flipping homes, but they don't have the knowledge, they don't have the experience, they don't have the credit, they don't have the cash, they really don't have any of the things that they need to be able to qualify for this kind of financing. And there's a lot of other creative ways that they can then buy real estate and be able to use it to flip or to buy and hold, but it won't be through financing if they don't meet those criteria. So you've got this kind of financing. They're using property as the collateral. Okay, basically funds in a house for seller program are available for short-term residential purchase and renovation projects. As you know, most traditional banks don't offer this kind of financing. Real estate investors, it's very tough to get financing. And then what happens with this kind of financing is it works kind of like a CP loan, a construction or perm loan in many cases, where what happens is the money gets put into an escrow account, and then the money is released in draws as the home is actually, as the rehab is actually completed. So account receivable financing, this is where receivables are used as collateral. This is the #1 kind of asset-based program that's out there. As a matter of fact, if you talk to people who buy businesses, they look for businesses that have account receivables, because usually the account receivables, that asset can be used to secure the SBA loan they need to buy out the business. So this is the most common kind of account receivables that you're typically going to find out there. Okay, now this is where, again, receivables are used as collateral. So receivables is when a business has customers that are paying them on terms. So for example, Credit Suite, we're a perfect example. Our clients can pay in a lot of cases over 7 months' time. So they come in, they agree to pay, enroll for a $3,000 package. We let them pay over 7 months. The fact that they owe us that money is a receivable. We can then borrow against those receivables to get money instead of waiting that full 7 months for that money to be paid, for example. So loan amounts of $5,000 to $20 million, so wildly ranging loan amount from people that just have a few receivables that have quite a bit, up to 90% of receivables can be advanced within 24 hours. To the norm here with most in the industry is 80%. Some of the new lenders that we're seeing in the space that are doing artificial intelligence, where they're actually using AI to go into the accounting software to look at the account receivables instead of aged receivable lists, which is what's always been used before. Those lenders will now go up to 90%. So what happens here is, let's just use a round number that's easy. Let's say somebody has $100,000 in account receivables, meaning their customers owe them $100,000. Well, that means that the borrower, or that means that that business owner that has those receivables, the customers owes that business owner money, that business owner can get up to 90% of those receivables advanced within 24 hours. That's 90 grand in this example. So instead of waiting months to get that $100,000, the lender will give them 90 of that $100,000 right away within the next 24 hours once they're approved. Now, it can take somebody usually 2 to 3 weeks on average to get approved for the first round of account receivable financing. The lender's going to want to see that aged AR, aged account receivable document, or whatever they may have, their accounting software, however they can produce it. They're looking for an aged AR report, basically an overview of how their account receivables perform, how many people are actually paying back those receivables that are owed. Once they've done that review, takes 2 to 3 weeks, then they do the very first advance. From that point on, whenever that but business has more receivables, they submit the receivables to the AR lender, and those receivables are then advanced within 24 hours. So then what happens is they basically, the difference of what the lender charges their fee is then advanced back to that business once those receivables are paid. So the way AR financing works is the lender will be the one that then collects the payment. So let's use us as an example. So our customers pay us, some of them over 7 months time. Well, what would happen is the minute we would get AR financing, we as a company would stop collecting the money. The lender then takes over. The lender is the one that wants to get the money and make sure that the actual customer, the lender is the one that wants to make sure that those customers actually pay the business owner, because that's how they're going to get their money. So the lender takes over the actual recovery of that money, so the business doesn't actually do so. Once these receivables are paid, once all those invoices are paid, then the 10%, remember, then go up to 90% of the receivables. The other 10% minus the lender's fee is then supplied to the business owner. So the business owner gets 90% of that money right away. The lender collects. When the rest of the receivables are paid, the lender then gives the business the 10% that's outstanding minus their fee. Now, this is based on what are called discount rates, and about 1 1/4 to 3% discount rate is common. Although these rates look very low, this could easily be for every week that the money is outstanding, sometimes month. So that means that the longer the person takes to pay that receivable, the more interest it will actually cost. The more interest it will actually cost that business with this kind of financing. So again, this kind of financing probably isn't going to work really well in our example, where somebody's paying us over 7, 8, 9 months. A lot of lenders won't even work with that. But if you have a business that's accepting payments and only getting paid over weeks or a few months, then it's going to work better for them, and their fee won't be as high. And there's also a 4% fee, which is very common in the very beginning part of the loan that's charged the first time out. And again, that fee will wildly vary based on risk and based on lender. No credit score requirements to qualify, because they don't care about your credit. If you think about it, the way that this kind of financing works, they're getting the money directly from the customers paying the business owner. So they don't care about the business owner's credit. They care about the customers, the business that are paying the business owner's credit. So they'll oftentimes do research into those customers that the receivables are with to make sure that those customers have a good reputation for paying their bills. So they care more about the quality of the business owner's customers than they do the business owner, the actual applicant for the loan. They care more about the applicant's customer's credit than their own. So consumer credit quality really doesn't matter here. Now, again, receivables are used as collateral. I don't know why I have some of the same slides here twice. It's weird. Receivables must come from another business or government agency, not an individual. This is pretty much the case. There are some lenders you may find out there that will accept receivables from individuals or consumers, but most of the lenders want the receivables to come from the government or from another business instead. Businesses must be open for at least 1 year to qualify. This is pretty standard. Again, not saying anything is a steadfast rule. There are always lenders that will do exceptions and that work in niches that most others don't. But 1 year in business is very common with this kind of financing. Medical receivables can qualify along with construction and conventional receivables. So the way that this works is that there's basically 3 main forms of account receivable financing we see. We see medical, construction, and conventional. And the reason for that is that medical, this is where insurance agencies and Medicare, Medicaid take time to pay back doctor's offices, for example, is very, very, very common type of receivable. Construction receivables are also very common, where you have a bunch of contractors that are contributing work to build homes, but then they don't get paid for many months until those homes are built and sometimes sold. And then conventional receivables kind of is a category that encompasses everything except for the medical and the construction. Now, medical needs about $600,000 in annual receivables to qualify. This is from one of the lowest volume lenders that we work with. Again, varies wildly based on lender. You may find some account receivable lenders that won't even touch medical receivables unless they have millions of dollars with the business. Some are as low as 600. You might find some slower or some higher than that, but medical is the one of these types, medical, construction, conventional, that does have minimum requirements of how much money the borrower has to even have in receivables before they'll be considered. The reason for that is that this is a nightmare for a lot of lenders to collect. To get money from Medicare, Medicaid, insurance companies, it's so difficult to collect that it's just not worth their time unless the business has a volume of those receivables. And as a business loan broker and it's somebody that's getting paid on the money, then this could be very lucrative because, again, as a partner, you're getting paid on these monthly. We don't make a lot of money on these. Account receivables won't be a big payout, but the nice thing is that it is recurring money. Once somebody usually goes into this kind of financing, they don't usually come out maybe ever, definitely not till years down the road in a lot of cases. So that means that you won't make a lot of money on this, but you will earn recurring money every single month on AR financing. So there are lenders now that offer AR credit lines. And again, the AR is receivables are needed for approval. The lender's plugging into accounting software. This is very new. Okay, in the past, you've always supplied an aged AR report. So you've always kind of shown with a report how your AR performs. Nowadays, this AI plugs right into QuickBooks, Xero, the accounting software, and automatically determines that. So it's taken what usually took weeks to accomplish approval-wise, and it's opened up things like credit lines, which is kind of a new way of doing this kind of financing, and made them possible very quickly within days. Okay, rates are very low on this, a 0.5 point to 0.7% for week outstanding, and usually the loan terms, the payback on that line can go as much as 6 months, and there's no prepayment penalty on that as well. Some of the sources on this don't have consumer credit checks as long as there's not a recent BK, and very, very, very fast funding. And typically somebody that has higher receivables or higher revenue can qualify for more money. So PO, or purchase order financing, is where somebody has a purchase order of about $5,000 or more, and a borrower can get up to 95% of the purchase order advanced and the 5% less the lender's fees released once the actual invoice is paid. Pretty cheap rates, 1 to 4%, obviously can vary based on risk and lender. No credit score requirements to qualify. Letter of credit's issued initially, and it can't be unfurnished goods. So the way this kind of financing works, and I don't know why, but I always use exactly the same example whenever I talk about this. Think of a t-shirt embroiderer that needs to basically come in, and he has a huge order come in for t-shirts, and they don't want to go spend all their money to buy the actual t-shirts, and then that really creates a cash flow crunch for them. So they use PO financing to get a lender to issue a letter of credit to the supplier stating, look, you ship the shirts and we will release the funds. Then the shirts are shipped. I don't know why shirts and shipped is messing me up language-wise today. So the shirts are shipped, and then the money is released to the supplier. The actual business gets the shirts. They embroider them. They then go ahead and give those to whoever was the one that had the order, and then boom, the order is done. And they were able to get the money they needed to get the shirts to finish the order without using their own cash flow, money from their bank account to do so. So purchase order financing, fantastic option for a business that actually has purchase orders that need to be fulfilled. Okay. So book of business financing. This is where commissions from the book of business service collateral, and it's for insurance agents only. Okay. So look, a lot of people might have a book of business, but insurance agents have what are called renewable commissions. And you're familiar with this. I am too. Okay. My car insurance renews every year and I don't care, right? I still have been with my same insurance company for, I don't know. I know since my wife and I got together, which is at least 16 years ago. So insurance renewables, what happens is even though every year our policy does update itself automatically and we get new cards and notices in the mail, that's a renewable commission to the insurance agents. They keep getting paid every single time we renew, and we're not doing anything to renew. It just happens automatically. So this is the way the insurance agency, this is the way the insurance world works, and these kind of renewable commissions can then be used as collateral for these insurance agents to borrow and get money. The terms are very long, 3 to 10 year long term. You're usually not going to see anything that long unless it's something like an SBA loan. 4 to 9% plus the prime interest rate, 520 plus FICO score or higher is what's needed. And the borrower can get as much as what's called 120% of the surrender value of their insurance. This is commonly what it is. All of the lenders in this space, there's not a lot, but the lenders are a little bit different. But what this means is it means that if that agent, that Geico agent, was going to sell back their book of business to Geico, how much money could they get for that book of business? That's the surrender value. They can usually get as much as 120% of the surrender value. No State Farm agents, because they don't own their own book of business. Now, what's interesting about this is that in my time in financing, which I've spent about 18 years in the financial services space, I was at a loan broker conference the other day and was referred to as a dinosaur, which was quite interesting. I've never been referred to as a dinosaur before, but I guess I've been around the space for a long time. And I can tell you that 100% of the financing I deal with, almost all borrowers want more money than they can qualify to get, right? Most people want more of a home than they can qualify for a mortgage to get. Most people want more of a loan than they can qualify to get. This kind of financing is extremely unique, because with this kind of financing, we're typically getting people approved for way more money than they actually end up taking. Usually they come in, they say, okay, we run the agents through this process, we get them approved, and usually they qualify for way more money than they end up wanting. So the reason I tell you that is that insurance, or the approvals on this kind of financing, are just extremely, extremely high. Now, the two common uses of financing for this is one, people that are doing things, expanding their business, need the money for general purposes, etc. And two, insurance agents that are using this kind of financing to buy the book of business or an agency from another party. That's where it's probably more commonly used. So a buddy of mine, Jeff, owns an insurance company around here locally. If he found another insurance company that he wanted to buy out, well, then he could use their own book of business as collateral to get the money he needed to buy that actual agency. Now, believe it or not, when people buy businesses, this is very common. Like I mentioned, account receivable is the #1 asset that people that buy businesses use to get the money that they need to buy the business. So they're actually using the assets of the business to buy the business. Very common in the insurance world, using book of business financing to accomplish that feat. So equipment financing. Equipment financing works for even startup businesses, very important. If you have a borrower that says, I want $50,000, you always have to ask why. And if they say it's because part of it's for one big piece of equipment, well, then you want to get them equipment financing for that equipment. Don't get them a credit line or a loan to use for equipment if it's not equipment financing, because you could get the loan or the credit line they could use for other purposes and then get them equipment financing to actually finance the equipment that they need. Now, you can typically get $10,000 to $20 million loan amounts, 12 to 48 month terms, so up to 4-year terms, rates of 5 to 55%. We've actually seen as high as 65% interest. I know, it's crazy. But again, in that example, what happened was the guy bought a tree destumper to destump a golf course. By the way, never even knew a destumper existed, let alone what it was or what it did. And he was paying all these people manually to pull stumps out of the ground. So this destumper saved him $10,000 a month, even though he was paying 65% interest. It was such a crazy scenario. But again, interest is based on risk. So a wild range like this shows that they'll deal with low and high risk borrowers, which is a good sign. And again, if the benefit outweighs the cost, then why not? Because you're writing the interest off and getting it back on the taxes anyways. 580 or higher FICO score. Some of these lenders focus on the lower credit score tier, the lower credit score niche. And again, those people obviously pay higher interest. And about a 650 or average credit is what's really preferred. And as little as the first and last month's down payment is what's needed. So one of my friends wanted financing. She came in with an example and said that they needed about 50 grand. Asked her what she needed it for. One of the things she needed was a piece of equipment. We got her unsecured credit lines to get her well more than 50 grand. We got her like 75, 80,000. And then we had her use the credit line to pay the first and last month's payment on the equipment financing. So she didn't have to tap into her credit line to buy the equipment. We helped her get equipment financing and helped her use the other financing we got to pay the first and last month's payment. But believe it or not, this could be some money. You know, the payment on this kind of equipment, depending on the kind of equipment, could be $1,000, could be thousands of dollars. So I've seen a deal before where this first and last month's payments was even too much money for the borrower to be able to afford. So again, sometimes combining different kind of financing and having the ability to do that helps people to get into financing like this, because you can get the money they need to cover the first and last month's payment if they don't have it. Now, equipment leasing, a little bit different. Somebody needs to be in business 1 year or more, can't get it as a startup, 10 to 20 million, same loan terms, rate, same everything else. The difference is that leasing typically will be on the lower side of interest rates. They are typically cheaper to get than financing, a little bit harder to qualify for than financing, even though I say 580, 650 credit scores, what is the bare minimum. They want to see a little bit better credit scores, and they want to see 1 year in business. And if somebody has that, they could typically get that same piece of equipment by leasing versus financing and pay cheaper payments. There's also equipment sale-leaseback. This is where a borrower can borrow against equipment they already own. It's called equipment sale-leaseback because what they ultimately do is sell the equipment back to the actual lender. The lender leases it back to them. And Erica says, do we have to have own equipment to get equipment funding? So again, do you have to own equipment? So remember, we've talked about 3 kinds so far. Equipment financing is to buy equipment. Equipment leasing is to lease or get equipment, right? So you're getting new equipment. This third type is where somebody already owns the equipment and they're borrowing against it. So it may be equipment that they already own. It may be equipment that somebody else already owns. So let's say I go to Grandpa, and instead of getting a $10,000 loan from Grandpa, he has an old backhoe that he hasn't used and that he doesn't really have a use for. I could then use his backhoe as collateral to get the money I need, so Grandpa doesn't have to front $10,000 out of his own pocket, for example. Or maybe I have the big piece of equipment I want to borrow against. So typically, somebody can borrow against about 50% of the equipment value. A startup can qualify for this, 10 to 20 million. Again, a lot of the same things when it comes to qualifying. But again, you have to keep in mind they're going to be extremely conservative with the value of the equipment. If you have a piece of equipment that's probably worth 50 grand, don't be surprised if the lender values it at 25 grand. The reason for that is the lender's going to value the equipment based on what's called a fire sale value. If they had to do a fire sale and unload the equipment super fast, who would buy it and how much would they pay? Okay, that's what they're actually looking for here. And Constance says, is there a rewatch of this in a PowerPoint? Yes, the rewatch of this will be in your weekly coaching webinars in the back office. And when I'm done with this, I'll make sure that the PowerPoint gets there for you as well in your back office where the webinars are, which is under Partner Resources Live Training. So that's equipment financing. So we've got 3 types here. We can either finance it, we can lease it, both having to do with new equipment that we're getting, and then equipment sale leaseback is where we're borrowing against equipment they already have. And again, don't write this off as an option if the borrower doesn't own equipment. The next question becomes, who else around you may own equipment you could use as collateral to borrow against? And one other thing is, weird as it is, this question comes up a lot, you have to own the equipment. You can't be financing the equipment. If you're financing the equipment, you don't own it. The bank owns it. So you can't use something as collateral that's already being used as collateral. So in order for this to work, you'd have to own the equipment free and clear, and it needs to be one major piece of equipment. Okay, we have some borrowers that say, hey, look, what if I have 20 computers in my office? That cannot be combined to borrow against to get equipment financing. It's got to be one big piece of equipment. I think about bulldozers and backhoes and really big medical pieces of machinery, et cetera, et cetera. Inventory financing, 250 to 500,000 in financing, revolving line of credit, 2 to 5% rates. Rates can get much higher depending on risk as well. No credit score requirements. You've got to have 500,000 in inventory to qualify, and loans are about 50% of the value of that inventory. So look, there are extremely few lenders that offer this kind of financing in the country, probably less than 3. And very rarely, depending on the type of businesses you're working with, will you even work with the business that has $500,000 in inventory. But you do see these people on Shark Tank all the time. They're sitting on a bunch of inventory, something happened. I saw one of these the other day where she did something, the product went viral. She had all these orders. She went and bought all this inventory. Then the virality died down. She doesn't know how to properly market. So she's sitting all this inventory in little cash. That's a perfect example of somebody that could use the inventory to get a line of credit to ease cash flow needs. So that way they can get the money they need using the collateral, the inventory, as collateral to actually borrow and get the money that they need. So again, you've got to have at least $500,000 in inventory. A lot of borrowers you're dealing with won't have this. But here's what's nice about all this financing that I'm teaching you. You could find a niche in any of this and just do that all day long. Meaning if you just worked with retailers that are sitting on high amounts of inventory, since there are only a few lenders in the country max that even offer this, most have never even heard of this, never even know exist, and you could make your entire career on just finding these people that have the huge amounts of inventory and then going in and offering them this kind of financing. But again, it's very rare. Not a lot of lenders offer it. And if you're not looking, you're not going to typically run into a lot of people that are sitting on $500,000 in inventory. What's needed is a good inventory management system. They have to actually know what their inventory is. Anybody that's seen the show The Profit with Marcus Lemonis knows how rare this is. A lot of the people he comes in with, they have an idea of the value of their inventory. Then they start actually going through and really seeing what it's worth. And it usually is only worth a fraction of what they estimated it was worth. They have to have a good inventory management system if they plan on using the inventory as collateral to be able to get financing. Securities. So this is where somebody can get up to a 90% of the stocks or bonds, the value of the stocks or bonds, 5-year loan or credit line, prime interest rate plus 2%, no FICO score requirements. Most stocks and securities are accepted. Okay, and what happens with this kind of financing is somebody's basically using stocks and bonds as collateral to get financing. They can still earn the interest on those stocks and bonds. The only thing is if they default, then the lender takes back the stocks and bonds. That's what's nice about having collateral-based financing or asset-based financing is that, look, if you default, the lender just takes the asset that you have. So if the asset directly is proportional to the loan amount you're getting, or even less in this case, the lender has very little to lose unless the stock value just plummets. So again, by 90% of stock value, they're giving the borrower room, anticipating that stock value could drop. So if the borrower defaults, well, then they're not really out anything because all they do is take the stocks, they liquidate the stocks, and they get their money back fairly quickly. So it's a pretty secure way for businesses or for lenders to lend money. And in doing so, the interest rates are pretty low. Interest rates are pretty low on this, pretty easy to get approved. Credit doesn't matter. Cash flow doesn't matter. All somebody needs are stocks or bonds. The other nice thing about this is that it isn't easy, but it is possible for a borrower to use somebody else's stocks and bonds to get money, kind of the equivalent of a guarantor. So why this is a big deal is that 75% of business owners get money from family and friends. So instead of going to dad to try to get $50,000, where dad's got to liquidate stuff to get the 50 grand, he may pay penalties on that. He won't earn the interest on that money. Well, instead, dad could use his stocks as collateral. I get the credit line to fund the business, and dad is only affected if I default on the credit line. Well, if he gave me 50 grand in cash and I defaulted on that, he'd be out the 50 grand in cash anyways. So he loses the same whether he's giving me cash or this kind of financing. So it makes it easier for borrowers to get money because instead of the 75% of them going to family and friends, they can go to family and friends and say, look, do you have stocks I could use as collateral? If the person does have the stocks as collateral, then that's going to be easier for them to get financing using those stocks than it is to expect that person to give you a bunch of money in cash. So again, it just kind of opens up the options and it makes it easier for somebody to come in and get money from guarantors using this kind of financing. Commercial real estate, $75,000 to $20 million loan amounts, 55 to 65% loan to value. They're going to want full financials, tax returns, P&L, debt schedule, etc. Business has to have cash flow to make the payments. Remember, that's what they care about here. The same if you're buying residential property, if you're buying apartment complexes, what the lender's most concerned with is does the property cash flow? And by that, they mean, does the property actually generate enough money to pay for itself? So that's what we're looking for here, is the business must actually come in, and the business has to actually have the money to pay back what's being borrowed. So if the business is generating enough money, and keep in mind 2 years financials, tax return, P&L debt schedule, it's all being used to determine this. I love that. I personally love this part of lending. Borrowers don't think of it this way, but I do. When I see this line, 2 years financial, tax returns, P&L, and debt schedule, the very first thing I'm asking myself is, what do they want this for? What are they looking for? And you need to, whenever you're dealing with borrowers, you need to think that way. Don't just get documentation to lenders, because lenders are asking for the documentation. You need to know that the lenders are asking for every piece of documentation for a specific purpose. You should always ask yourself, what do you think that purpose is? Then look at the documentation, and does the documentation help or hurt your cause, right? If you're going with revenue lending and the financing is completely based on the revenue the person has, and you look at their bank account and they have 30 days in a month that they had non-sufficient funds, probably not going to qualify, because their revenue, they're not managing the revenue responsibly. Same thing here. If these financials don't show there's very much profit, then there's not going to be enough profit to make the payments, and the lender's not going to want to lend. Average credit score is needed. Personal guarantee is required. 4 to 5% interest rate or higher, depending on prime rate, what rates are at any given time. 500,000 to 20 million. Again, on higher loan amounts, you can go as low as 75,000 loan amount with some sources, purchase and refinancing, and somebody can also do blanket loans and can do other kind of financing as well, where they're actually getting one loan for multiple pieces of commercial or residential property. So you can get a couple. There's alternative financing with commercial real estate financing, and there's also SBA 504 loans. So we'll talk about SBA a little bit later today. So SBA 504 loans, a 504 SBA loan is for the purpose of purchasing equipment and or purchasing real estate. So an SBA 7A loan is just like general purposes, working capital, but a 504 is their real estate loan. So you're going to be able to get financing through alternative financing sources, or you're going to be able to get financing through SBA 504 financing, or you may choose just to work with an actual mortgage broker that focuses on this and get a referral fee there. Anyway, you look at it, there's a lot of different options. 401ks or IRAs. This is very similar to what we just talked about with stocks and bonds, where somebody's using a 401k or IRA as collateral. Now, unlike stocks or bonds, they can get as much as 100% of what's in their 401k advanced to them on a 5-year loan or a credit line, and they get prime interest rate +2, no FICO score requirements. Lenders typically will roll in a fee. There are multiple lenders in this space. The ones that we typically work with have a fee of about $1,995 that we roll in. You should tell your borrowers this up front, because again, what happens, this is what I've learned, is that if you tell the borrower exactly what to expect, they go to the lender and they get exactly what you told them to expect. It's in a lot of cases very smooth sailing to the finish line to fund that deal. The problems occur when you don't tell a borrower information, or what you tell them is different than they find out from the lender. Then they question everything. They question the lender. They question you. They question the loan program, because it doesn't all add up. In a perfect world, we want to tell borrowers exactly what to expect. They go to the lender. They get exactly what you told them to expect, and then the loan closes. If you don't tell them things like this, there's a fee and there's a surprise at the end, then there's a much greater chance they're not going to go through because the fee surprised them. No penalties for rollover. So this is based on IRS tax proven strategy. So think of it like this. With a 401k, you're basically just investing into other people's businesses, right? That's what you're doing. You're basically investing into other people's businesses. That's what stocks are. Okay. When we look at having, anything invested in the stock market, those are basically public companies that you're investing in, right? So with 401k or IRA, you're basically just taking that money and redirecting it, reinvesting it into your own business based on tax-proven strategies where you don't pay penalties. Now, I say 100% of the financing of what's in the 401k, but that means 100% of what's actually rollable. What's rollable means whatever's not with a current employer. If I'm currently employed with somebody, then in my 401k is with them, then what happens in that scenario is the employer will probably not let me use the 401k for other purposes. The employer will restrict it. So whatever's not with a current employer, whatever's not rollable, or what actually can be financed, again, what's not currently with another employer. Commercial vehicle financing. So this is where we're getting money to purchase commercial vehicles, buses, trucks, emergency vehicles, others. Again, not a lot of sources that do this, pretty niche product. Can borrow against free and clear vehicles as well to refinance. I'm not going to say a lot about this because we don't really do a lot of this kind of financing, although we do have access to it, but it is available for people because we get this question a lot. Can you refinance vehicles? Can we get financing for vehicles? Yes, there is financing for vehicles, but you're not going to use your jet ski trailer. You're not going to use your boat trailer. You're not going to use your beat up old Pinto as collateral. It's got to be commercial vehicles. This kind of financing is for like ambulance companies, right? That are getting like ambulances, these huge, ridiculously expensive rigs, or buses, or big trucks. So that's what commercial vehicle financing is. Now, don't forget, business credit can work here too. Somebody can get business credit without a guarantee and without a credit check and also get commercial vehicles. One of our clients just got approved for $140,000 with Ford, no PG, no credit check, for a beautiful big truck that she's using for her transportation business. So some ways you can use commercial vehicles to get financing as well. Now, that pretty much wraps up a lot of the most common asset-based kind of financing that you're going to deal with. We talked about 401k, IRA. We talked about stocks and bonds. We talked about account receivables and purchase orders. We talked about equipment financing, equipment leasing, equipment sale-leaseback. We talked about inventory financing. We talked about commercial real estate financing. We talked about house flipper financing using residential homes, and book of business financing for insurance agents, even commercial vehicle financing. So now that we're wrapping up kind of the 3 training videos here, we've talked about cash flow, we talked about credit, we've talked about collateral. I'm going to throw in a couple other things just to mention. Don't forget about business credit. The beautiful thing about business credit is that it's a catch-all. Everybody can get it. This is the only way somebody can get money if they don't have cash flow, credit, or collateral. We never want to forget this because look, all of us, everybody's going to want a $250,000 credit line, everybody. But a lot of people can't get that. And the people that don't have cash flow, don't have credit, don't have collateral, don't have a lendable strength, they still need to get money. So remember, business credit's the catch-all that can still get those people money. Now, also don't forget that when it comes to SBA loans and a lot of other lenders out there, business credit's a factor for approval. So even people that can get other kind of financing still want to build their business credit because the business credit oftentimes determines if they'll get approved or denied, the rates and terms they'll pay, and it also determines how much money they'll be lent. Remember, well, maybe not remember if you don't know this, commercial credit scores or credit reports have a recommendation of credit on them. They say to lenders and credit issuers how much money you should be lent. So by building business credit, you have that number get higher and higher, which gives you the best chance of getting the most amount of money. Bottom line, business credit's a catch-all to get financing when you can't get other kind of financing, and it also helps you get the most money at the best terms on the financing a borrower can get. So remember, with business credit, borrowers are coming in, or I should say customers are coming in and getting immediate vendor credit. Then they're using that to build the initial business credit profile and score. Then they're getting high limit credit cards for fleet credit, for gas cards, fuel cards. They're getting Visa cards, MasterCards. They're even coming in and able to get retail credit as well. Amazon, Best Buy, Apple, Chevron, Sunoco, etc. They can get that kind of credit as well. So again, high limit credit cards. Okay, no personal credit check or guarantee, no financials, bank statements, it's no doc, works for startups, works for almost any situation, even nonprofits, reports only to the business credit reporting agency, so utilization doesn't affect personal scores, no inquiries. And again, as we talked about, business credit determines how much somebody will get, they'll get approved, the rates and terms that they're going to pay. So look, I think this is very, very, very important to get a borrower the most amount of money, and here's why. Because when I have a client that comes in and says, I want to get $50,000 in money, the first thing we say is, what are you using the money for? And if they say, I'm building out an office, I need 10 grand for computers, I need 10 grand for furniture, I need 10 grand for supplies, then the last thing we're going to do is go below a $50,000 loan or credit line on stupid crap they could use business credit cards for. Within 60 to 90 days, we can get them the $10,000 at Staples and $10,000 at Apple or Dell for computers and $10,000 at IKEA or Amazon to get the furniture. So why below a $50,000 credit line on stuff you could use business credit cards to buy? Business credit cards are much easier to get than loans and credit lines. So use business credit along with the other kind of financing borrowers get. That's how we get them the most money. Again, if I have a client that comes in and says that and then they need another 10 grand for equipment, we're getting them a $50,000 credit line they could just have whenever they need it. Then we get them the $10,000 in equipment financing, use the credit line to pay the first and last month's payment of that equipment financing. Then we help them build business credit to get the office supplies cards and the computer cards and everything that they need to buy the other stuff they need. Now they love us, because they wanted a $50,000 credit line. We got them a $50,000 credit line. And since we got them business credit cards and equipment financing, they only ended up needing $2,000 of that 50 grand for the first and last months of equipment financing. Now they love us. They still have 48 of their $50,000 credit line left because we strategically and smartly used business credit cards and equipment financing to get them the rest. This is the way you must think to get borrowers the most amount of money and to stand out in the space when other people are just trying to get one kind of financing when you can use multiple. Now, don't forget with SBA loans, somebody does need to go full doc. Bank statements, P&L, personal bank accounts, and business bank accounts are needed. The reason I'm bringing this up at this point is just strictly because with SBA loans, somebody has to have collateral. They need good credit, they need cash flow, and they need collateral. So if they have collateral, if a person has these kind of assets and they have cash flow and good credit, there's a good question they may qualify for this kind of SBA type of financing. So remember, good credit's needed. They've got to have good business credit. They have to have good bank credit as well, which means they need at least $10,000 in their business bank account averaged over 90 months. But SBA will accept personal and business collateral. They'll even accept the house as collateral. And somebody else also can get these cap lines, which is SBA's credit line program. They can get seasonal credit lines if they're a seasonal business. They can get a contract line or a builder's line if they're a contractor or a builder. They can even get a small asset-based line or a standard asset-based line for cyclical growth, okay? Recurring or short-term needs that they may need the actual financing for. So again, we just kind of went through this whole process here: cash flow, credit, and collateral. That's what's needed for a borrower to get money. Cash flow. This is based on cash flow financing, merchant cash advances. We're looking at bank account management, sometimes even tax returns to determine approval. Remember, if they have one of the C's, they don't need the other. So if they have cash flow, they don't need good credit or collateral. If they have good credit, well, then they can get up to $150,000 in unsecured credit lines, as we talked about in our credit and asset-based financing. Even as a startup, remember, they don't need cash flow and they don't need collateral, because if you have one C, you don't need the other two. If they have collateral, like we talked about today, as you saw, a lot of interest rates below 5%. This is way lower than SBA, way lower than any other kind of interest rate financing they're going to get. So if they have collateral, use it. Okay, we had a client that tried to get $25,000 in funding at his bank for his bar. He already owned the bar, was trying to get money to expand the bar. They wouldn't give it to him. He had a 401k. He was a retired police officer, and yet we were able to get him $750,000 in 401k financing. Can you imagine that? He felt betrayed at his bank because they wouldn't give him 25. Comes to us and we get him $750,000 in funding. So again, using this kind of creative financing is what gets you more customers, more referrals, because you're able to do things with having financing that ties into all three C's that banks and other people that only have one can only get some of that financing. So collateral-based financing, don't need credit, don't need cash flow, opens up a lot of options. And don't forget, you and I, we've got the huge benefit of also accessing business credit, which most loan brokers don't have access to. So because most loan brokers don't even know anything about business credit, most people that are working with borrowers like we are don't even know anything about this. And if you are working in that space and helping borrowers, then again, you are some which way a loan broker. Okay, even if you're not licensed and you're doing the financing through us where we have the necessary licenses. So the benefit is it gives you a huge competitive advantage because you have business credit that's a catch-all to help get everybody financing, even if they don't have one of those three C's. And The fact that you offer business credit even when they can get other kind of financing shows them how committed you are to making sure they can get the best terms and the most amount of money for their business in the future. Also, remember, we are very big on graduating borrowers from one type of financing to the other. So if they can get cash flow financing, we help them with understanding the importance of improving their personal credit, even get them to companies that can help them with that, and then help them understand and start accumulating assets with account receivables so we can graduate them to term loans, lines of credit, even SBA loans. You and our goal has to be this. It's not just to get a borrower money, it's to be able to get the borrower all the money they can get now, help them understand how their fundability works to make sure that they're set up credibly, and also to build business credit to get even more money down the road, and then help them understand what it takes to get the term loans, the lines of credit, and even graduate to an SBA loan. We want to be with them from the first time they get financing all the way and help them graduate to the end. That is how you really serve your customers that are looking for money. So I'm going to go ahead and open this up for any other questions. Do you have any other questions that I can help answer on collateral-based financing, cash flow-based financing, or credit-based financing? Let me know. So today we talked about the final form, collateral-based financing. Don't forget to look back at our other financing, our webinars on this topic, credit-based financing and cash flow-based financing, to get an idea of how the other kind of financing works. And again, if you have any questions, make sure you contact us directly. You can give us a ring at 877-600-2487, info@creditsuite.com. All partners have a contact tab in your back office. You can easily access that contact tab with a secret reserved number right to your support team, as well as numbers and contact information for business advisors and our finance team as well. So all of our back end contact information is available in your back office. So Constance says this is extremely informative and priceless knowledge. Definitely we'll watch again. ABS structure always to attract clients. Cool. Great. I'm glad that this makes sense. Remember, it's super simple to remember how somebody can get financing. It's really based on this 3 C's formula. Do they have cash flow? Do they have credit, or do they have collateral? If the answer is yes, there's a good chance they may qualify. If the answer is no, then you want to introduce them to business credit and also introduce them to this formula to let them know what they need to do to accumulate the financing. No other questions. I'm going to go ahead and wrap this up. If you have any questions, reach out. And Janelle says, great info, Ty. I got my 5K back from Postcard Came Back. Yes, great job. Janella, that's awesome. Do me a favor if you don't mind. You have my email because we set up a call. Let me know what kind of return you got on that postcard campaign. I was so worried when you spent the $5,000 on postcards that you get that return. I am so pumped that you got the return. I'd love to know more about it because I asked you to give me that feedback so I could pass it on to our other partners. So I have some kind of feedback about the success of postcards. I'm super, super pumped. Back. Oh, you got my money back. Okay, so you never ran that campaign. Okay, cool. That's great. I was concerned that you were going to dump the $5,000 and not get the result, but I'm glad to know you got that back. And we talked about several other ways you can use that for marketing and advertising. So that's cool. God, congratulations. All right, I'm going to wrap this up. If you have any other questions, let us know. We are here to help you. And remember, now you know everything you need to know to offer financing for your team, for your customers. If you have any questions along the way, just reach out to us and let us know. Thanks, everybody. Have a great day.